Ladies and gentlemen, my name is Jesse Vergally, and you're listening to Working Capital, the real estate podcast. My guest today is Antony Davies. Antony is the Milton Friedman Distinguished Fellow at the Foundation for Economic Education and Associate Professor of Economics at Duquesne University. He's the author of Understanding Statistics, which is from the Cato Institute. He's also co-host of the weekly podcast Words and Numbers. He has authored hundreds of op-eds appearing in the Wall Street Journal, Los Angeles Times, US Today, New York Post, and the Washington Post. And most importantly, from my point of view, he is the guy that explains economics to me in a very easy to understand way with millions of views on YouTube. So you can check him out there. Antony, how you doing?
I'm well. Thanks for having me.
Well, thanks for coming on. I really appreciate it. What we like to do on this podcast is not only have real estate professionals or people in the industry come on, but also talk to economists and look at our market and understand it from the lens of an economist, because we're all playing in the sandbox with other businesses and other interests. So that's something that we always like to do. So before we get started, maybe you could give our listeners a bit of a background into kind of where you started, because it looks like you were in business, but also in academia. So maybe a little bit of a background for you before we get started.
Yeah, as any of your listeners who are entrepreneurs will know, entrepreneurship it's a bug, and you get it and you just can't help yourself. You go out and you start businesses. And so too with me, I started as a sophomore in college, started my own business out of my dorm room with a friend of mine. That business actually went on, has an interesting story to it. We started this, employed some of our friends in college, this sort of thing, moved out, got investment money, had an office. So I'm going to classes in the morning and I come to my office and I'm dealing with my secretary and calls coming in from investors and the whole thing, right? And this is like at age, 19 years old. That company went, I don't want to say it went bankrupt. We hit some financial skids. The company got bought out, and I shouldn't say we, because after it got bought out, I left, I went to graduate school. My partner stayed with it. He repurchased the company and ended up turning it into what today is Take-Two Interactive. That's the makers of Grand Theft Auto. So a multi-billion-dollar company. And I like to tell the story, although I put a big footnote, I had nothing to do with Take-Two Interactive, right? I started the germ that eventually ended up being that. But so I've gone back and forth between starting companies and going back to academia several times over my career. And it creates an interesting synergy, because on the one hand, I can bring some higher level thinking than you would normally find in entrepreneurs, because I'm trained as an economist to the business world. But also, I think kind of more importantly, I can bring some real world experience back into the classroom. And so when we're studying topics, I can tell the students, look, the topics, they're all here laid out in the textbook, but these are the ones that matter and these are the ones that don't. And the only way you would know the difference between those is if you had experience actually running a business.
Yeah, fair enough. The one thing I really liked about the courses, the real estate finance courses or similar courses I took in undergrad or grad school, was that those were ones where you're doing practical real world applications of these problems. And a lot of times the best thing for anybody looking at the MBA, there's drawbacks to doing it. There's benefits, but one thing that I really found was fascinating is the guest speakers that you have in on a continuous basis in most programs. So you can actually see somebody in the field that can kind of do what you just said here, give you some insight on what's important, what's not important.
Yeah, absolutely. And I think it goes the other way as well. I've noticed entrepreneurs who teach who don't have the academic credentials, and I'm not being a snob here. I'm simply saying that it's very important to have some sort. You don't have to have a degree, but to have some sort of academic background so that you can distinguish between what works because it should work and what worked by accident. And too often I'll find people with experience but not the training come into the classroom and say, here, let me tell you what works. Well, half of what they're saying are things that just happen to work by accident for them. It's not necessarily going to happen for anybody else. And so I think it's really important to have a balance. You've got to have both of those things, the theoretical underpinnings, but also the practical experience.
Yeah. So for listeners, you're at Duquesne University now. You're in Pittsburgh. Is that
That's correct.
Yep.
Mm-hmm.
And so I guess, part of the reason that it was topical to have you on is obviously we're in a but we're in a unique situation coming out of COVID. I know that, if you take the economist view of a technical recession, really doesn't get you very far when in the context of COVID, because I think most people would look at this more like a natural disaster than, a typical recession last year or the year before. So I think what would be nice to get from you just on the outset would be, let's start with inflation, because I think listeners and real estate investors in general, that we have felt the impact of that the most, either directly through inflation like everybody else in the economy, or in virtue of interest rates being risen by the Fed to kind of ameliorate that effect. So why don't you put it in context for us? What is inflation, and what is it not? Because the debunking videos that you do are great, and a lot of people have certain ideas of inflation where they kind of miss the mark. So maybe you could give us kind of an overview.
Inflation is the rise in the average prices of things consumers typically buy. So, and I think that last part's important. It's not prices in general, but we look specifically at things that consumers typically buy. And that includes all kinds of things, housing and energy and gas and shoes and food and the whole business. Average prices of that. If you see the average price go up, that's inflation. Now, be careful, because inflation doesn't mean that all prices go up. Some might go up, some might go down. It's just on average, they're going up. And so, right now you see an increase in the price of gas. Well, is that due to inflation, or is it due to something else? If the price of gas is going up because of inflation, well, clearly, this is rising, but it might go up for other reasons. It have nothing to do with inflation. In fact, we could be in a period of deflation, and yet the price of gas goes up. And what's going on there is the price of gas will be going up while other prices are going down. Now, that's not what we have going on right now. But when we talk about inflation, it's this average price is going up. Now, why do we make a big deal about it? We make a big deal about it because inflation occurs when the money supply grows faster than the economy. That's it. There's nothing magical about it. You get more pieces of paper chasing fewer numbers of goods and services, and the average prices of goods and services go up.
So one of the things that we've been told is this idea of you're printing money, you're putting more money into the economy, that should lead to inflation. And oftentimes the gotcha thing that somebody will say is that, well, that's obviously wrong, because over 07, 08, when we had quite a bit of money printing, there was relatively low inflation. And correct me if I'm wrong, was that a result of the money was being printed, but it was sitting on balance sheets of banks rather than going out and creating velocity in the general economy? Is that typically the framework?
Yeah, roughly speaking, that's it. Let me put a little more flesh on it. We had this massive printing of money, and the money largely landed in financial markets, not goods and services markets. And so you didn't get prices of goods and services going up. And people say, look, we can print all the money we want. We don't get inflation. But if you go back and you look at the stock market round about April, May of 2020. Now, what's going on? April, May of 2020, we've had a massive decline in economic output, the second largest decline since the Great Depression. Our unemployment rate hit 14% here in the United States, again, second only to the Great Depression. Nobody knew how long the lockdowns were going to last. Is this weeks? Is it months? Is it years we're talking about? Tremendous uncertainty. And no one was sure, not even the economists, what the effect would be. This was unprecedented, that we would step in and by fiat shut down huge swaths of the economy. Tremendous uncertainty, tremendous unemployment, tremendous decline in GDP. And if you look at the stock market rose over that period, like April, May, June, by almost 25%. That doesn't make any sense. Why would the stock market be going gangbusters at a point in time in which we're looking at this second worst disaster since the Great Depression? I claim that what was going on is all that money printing landed in financial markets, and part of where that money went was into stocks. And what happened? Stock prices went up. Now, when stock prices go up, we all cheer and we say, hey, that's great, the stock market's up. Yeah, but hang on. Those stock prices, again, I'm claiming, were going up not because companies were more valuable, they were going up because of all this money that we printed went into the stock market. Now, that doesn't affect inflation. Why? Because inflation calculations don't include stock prices. They only include prices of goods and services. Now, I claimed at the time, and this would have been back in fall of 2020, I said, look, I think this is what's going on. The money's gone into financial markets. And if I'm right, then as COVID starts to fade away and the lockdowns are removed, we start to return to normal, we should see two things happen. One is that the stock market should top out or even start to decline. And the other is that we should start to see lots of inflation. Why? Because when everything calms down, all that money that was parked in financial markets, people are going to start releasing it. It's going to come into goods and services markets. And so you'll see the stock prices start to go down, the prices of goods and services go up. And what happened in fall of 2021, a year later? That's exactly what happened. We saw the stock market level off and start to tank, and prices of goods and services rise.
So would that, so part of that conversation is splitting the inflation between asset and financial services and the actual goods and services.
Right.
Now real estate is somewhere in the middle in terms of, being brick and mortar physically, but what fuels the real estate market is the debt of our industry. So we saw our industry pretty closely follow the stock market. We had, especially in certain markets, a hockey stick graph. Do you think that same logic would apply as to why the real estate market continued to go up during that time, where you didn't see inflation download to goods and services, but you saw assets, different types of real estate investments continue to have record levels of pricing?
That's entirely possible. Now, you know more about that market than I do, but what I do know is that even going back into the, prior to COVID being over, so think summer, fall of 2020, we saw tremendous, at least in the United States, tremendous activity in housing markets. People were building, you couldn't get, the price of lumber shot through the roof because people were building houses all over the place. And that struck me as incredibly strange. Why would you be building houses, again, in this economic, in this period of economic volatility? And, part of it, I think, is explained by remote work. So many of us were now working remotely, and many of us anticipated that would be kind of a quasi-permanent thing. And so people who lived in the cities moved out. They moved to the suburbs where, they could do that because they're working remotely and they're building houses to live in. And so that's part of it. But part of it, as you say, may have been fueled by not the desire for housing to live in, but the desire for housing as an investment.
So that being said, so inflation, those are the mechanisms. Now, for the average person, or even on our end, the real estate investor, one thing I always tell real estate investors is one of the nice things with real estate is, you can call it inflation hedge. You can use whatever term you want. We're in a business where we can download inflation to our customers, i.e. renters, whether you're in industrial, multi-res, name the asset class. That's one benefit that we typically have. But that being said, what's an ideal target for inflation before we get to the tools of how to lower or increase depending on the market we're in? What's the danger of the path we're headed if this inflation is not a transitory phenomenon?
Right. So I'd say in an ideal world, the ideal inflation is zero, because to the extent that you and I can anticipate what the value of the dollar is going to be in the future, you and I are more comfortable making long-term plans. And so the economy will tend to grow more because there'll be more investment, because we can make long-term plans, because we're confident in the future value of the dollar. So the ideal is zero. Now, in practice, because of all sorts of human frailties and misunderstandings and frictions, we can't hit zero. So the Fed goes for 3% thereabouts. If you get it in the ballpark, the Fed feels comfortable there. And Americans seem to feel comfortable with that. That's what we've kind of had, 2-3% over the past few decades. The problem comes in when we're all expecting 2 to 3% and all of a sudden it's 5 or 7, because you and I entered contracts. Maybe I'm renting from you, and maybe you've built into the contract an automatic 2-3% increase in rent over time. And I'm comfortable with that because I know that my income's probably going to go up 2-3% because that's what inflation has always been. That's going to be my cost of living adjustment. And so we all make the plans based on 2-3%, and all of a sudden it's 7 or 9. And now one of us is caught short. So we get caught short in long-term contracts. We get caught short in long-term investments whenever there's some kind of change in inflation and things end up being not what we expected.
Yeah. So I think I mentioned before, you are the Milton Friedman Distinguished Fellow at the Foundation for Economic Education. I've got my Milton Friedman selected papers. I think I got through half of this and then realized that some of them were his actual technical papers. And I'm like, I think I left calculus a long time ago. But what's interesting is the first thing in here is his address for the prize, for the Nobel Prize in Economics. And one thing that he points out was there was this historical understanding that when you did have inflation, that unemployment would be low. And this concept of stagflation, where you get into this very dangerous situation where you have inflation, but in fact, employment or unemployment is going up. Are we in, is that a fear, or is that a risk in our current environment? What are your thoughts on that relationship in general?
Yeah, that's a great question. And up until a year ago, I would have said stagflation is for the history books. We experienced it in the 1970s, and that was that. It was an aberration. I think it's a possibility right now. The next 1 or 2 quarters will tell. So we're in this period of marked inflation, which we're already feeling. GDP in the US was down last quarter. It was actually negative last quarter, but it was significantly positive the quarter before that. The quarter before that, it was positive, but it wasn't any great news. It was a small positive. And so it's kind of like over the past maybe 3-4 quarters, the economy's sputtering. Now, is it going to sputter and stop, or is it going to sputter and catch fire and, then start running? We'll know that in the next 1 or 2 quarters. And I think if it continues to sputter like this and we end up with another negative quarter or a lackluster quarter, this quarter next, I think we may be looking at a renewal of stagflation, this situation in which we have a combination of both unemployment and inflation. Now, having said all of that, what gives me hope is that the last unemployment numbers had us at around 3.6% in the US. That's roughly where unemployment was prior to COVID. So in terms of unemployment, we're back to where we started. Actually, we may be a little bit better because we have a burgeoning gig economy now that wasn't nearly as burgeoning back prior to COVID.
So if you were going to look at the tools that, whether it's the Fed in the States or here in Canada, the tools that we have to defend against potential runaway inflation or even the extreme opposite, Economics 101, we talk about fiscal responses and monetary responses and why one would be used instead of the other. Just broadly, could you kind of give us a little bit of a context of how you would kind of defend against inflation and which one of those tools you would or wouldn't use?
Yeah, that's the key question. And I think before we hit the answer, I have to point out that we need to be careful. We've got a disease right now, this inflation. Politicians will have us focus on not eliminating the disease, but rather ameliorating it. So, they'll point to the aspirin and say, well, take some aspirin. Well, that'll cure the symptoms, but it's not going to cure the disease. And we can talk about things like, more prudent monetary policy or these sorts of things. And that kind of is like an aspirin at this point. None of it is touching on. If you listen to the politicians, they'll say things like, well, the root problem is greed, or the root problem is corporate profits, or the root problem is that other party over there, or the root problem is, minimum wage increase, or whatever it is. None of that is it. And you can tell because politicians never talk about the thing that is the disease. And that is runaway government spending. In the US, our federal debt officially is $30 trillion, which is like 140% the size of the economy. And we've gotten to the point where we're adding over $1 trillion a year to that. In fact, Congressional Budget Office estimates that for the next 10 years, and every single year, we'll add more than $1 trillion to the debt. What's noteworthy is that Congressional Budget Office historically underpredicts the deficits. So picture it being worse than that. So here's the problem. Deficits alone don't cause inflation. What's causing inflation is the fact that our federal government has borrowed so much money, it's run out of places to borrow more. Yes, Americans will lend more money to the federal government and foreigners will lend more money to the federal government, but the extra amount they're lending doesn't come close to the extra amount the federal government needs to borrow. Who's taking up the slack is the Federal Reserve. When the Federal Reserve, unlike any of those other people, when the Federal Reserve loans to the federal government, it increases the money supply. That's what's giving us the inflation. So yes, the inflation is coming from an increase in the money supply, but the increase in the money supply is being caused by the fact that the federal government is spending more money than it has, and the Federal Reserve is having to step in and loan it what people aren't willing to loan it.
Yeah, I don't think you get elected very often when you're telling people what you're not going to spend money on.
Right. And that's kind of the weird thing, because you and I and everybody else, we can sit back here and quite rationally say, well, there's the problem. We need to spend less. Okay. Now, in a practical sense, when we get together and say, okay, what are we going to spend less on? You say, well, let's spend less on this thing over here. And you and I think it's a good idea, but the people over there don't. And you say, well, let's spend less money on this thing over here. And you and I don't like that, but the person over there does. And all of a sudden, you're in a situation where nobody can agree on what we're going to spend less on. Furthermore, the politicians that are currently running for office, what are they saying? They're saying, elect me and I'll give you more stuff. The big thing in this country right now is forgiving student loan debt. Elect me and I'll forgive your student loan. That's going to cost the federal government over $1 trillion. And yet, who's going to vote for that? All the kinds of people who will get their student loans forgiven. And before you know it, we're going to have student loan forgiveness here, an extra $1 trillion that we can't afford to spend, all resulting from the fact that everybody's got their hand out. Yeah, they want the government to spend less, just not less on what they want. Spend less on what the other guy wants.
So what do you think the rational solution is to this? Because this isn't really just a U.S. phenomenon, here in Canada and other countries where this idea, where you hear people say, this is going to, our grandkids and our grandkids, they're going to be the ones affected by this. But we still seem to kick the can down the road and not deal with the issue at hand. So, what do you think are the policy determinations or the policy items that need to happen to actually deal with this in a serious way?
We're going to find that out, because you're absolutely right. We kick the can down the road. We've been doing that in this country since the 1980s. But you can only kick it so far. Imagine that you're going on a great spending spree with your credit card, and you charge and you charge and you charge. People warn you, you're going to have a bill that you got to pay. Yeah, but that's later. Let's just go charge some more. You can keep doing that until one day you're going to charge so much that your credit card company says, nah, that's enough. Now you got to deal with it. That's coming here. It's coming here within about 7 years, 7 to 8 years. The Social Security Administration itself anticipates that Social Security will be insolvent. And the Social Security Administration has said the following: to keep Social Security going, we're going to have to do one of two things. Either raise payroll taxes 20% or cut retiree benefits 20%. Or a combination of those two. And as you can imagine, nobody's going to be happy with either one of those. The workers aren't going to stand for a 20% wage hike. The retirees are not going to stand for a 20% benefits cut. And so what do? I think there's no option left but to print more money. But then you're going to get exactly what we're dealing with now, which is, 5-10% inflation. And so in my mind, I think 5 to 10% inflation is going to be the new reality in this country for the foreseeable future, until, this goes to your question, what can you do? Significantly cut back on government spending. And one way to do that, a big way in this country, is to revamp Social Security. And by revamp, I pretty much mean get rid of it.
And that for the U.S. economy, what percentage is Social Security? I know it's I think it's your largest percentage of GDP, right? As an expense.
It's the second largest line item after Medicare. It's pretty close behind Medicare. Medicare's like, last time I looked, I think Medicare's like 1.2 trillion, and Social Security is roughly a trillion. So between the two of those, that's half of the budget right there.
That's half, yeah.
So,
Because I think most people would just, as an outsider, think, oh, it's the military budget, but I think that's like the 20% or the 1/5.
Not even. Yeah, the military's 15% of the federal budget.
So that, I mean, that it's the same kind of context we're in right now. Now, for the real estate investors, in our world, the biggest impact to us is, like you said, is that somebody tells you to stop, you can't spend on the credit card. And it reminds me of, not me personally, but my father. Anybody's survive until 95 was a term that Sam Zell invented or created in the 90s, because the commercial real estate market in the early 90s just went through a crazy time in terms of bankruptcies and these large companies that banks were calling due their debt. And people forget that that's always an option today. You come to the end of a term, the bank can say, okay, we're done. It's not automatic that it's renewed. So there's, I think, in business and entrepreneurship or in investing, there's that real risk that we face that you could lose that, as opposed to government things that the government gives us. So from that context, interest rates right now have gone up substantially. Any of us that have invested 5 or 10 years ago, that's especially 5 years ago, that's refinancing debt or buildings, are paying 2, sometimes 3% more for commercial mortgage-backed securities, or our version of Fannie Mae, Freddie Mac, CMHC. First of all, what's happening in the interest rate environment right now? What is the Fed trying to do with the increases? And do you think, like you said, I think you alluded to earlier, the big thing is not necessarily the rate, it's the expected rate in inflation. Right. And I think one thing that's been done, I think, better than it had in 08, 09 is they're kind of telegraphing a little bit more to us that it's not a surprise that interest rate increases have happened. But what are your thoughts on what the Fed's doing and the efficacy of it?
Well, what the Fed is doing, we say the Fed is raising interest rates, which is kind of a shorthand. What the Fed's doing is contracting the money supply. And in contracting the money supply, interest rates go up. So on the one hand, the Fed's contracting the money supply in an attempt to compensate for this inflation, to keep the inflation under control. And you notice immediately there's a trade-off here. And the trade-off is, you can contract the money supply to keep inflation under control, but you're going to get high interest rates. Or you can relax the money supply, that gives you nice low interest rates, but you're going to be suffering some inflation. So on the one hand, this is going on. On the other hand, interest rates in this country, and I would imagine a similar thing applies in Canada, have been what I would call ridiculously low for 30 years, maybe more. We do something with interest rates that we don't do anywhere else. We let the Federal Reserve kind of set them, or if not set them, at least manage them. We don't do that with cars. We don't ask the government to manage the price of cars. We don't ask it to manage the price of housing. Well, sometimes we do, to bad effect. We don't ask it to manage the price of food. The market deals with these things. And when you see a price go up, the price of cars go up, we know what's going on there. Something that's involved with the production of cars, the price of that has gone up, and so it's caused the price of cars to go up. Or, conversely, there's been an increase in demand for cars, and that's causing the price to go up. And we understand that the price of cars reflects what's going on with the production and consumption of cars. But when somehow it gets to financial markets, we throw all that out the window. And we think, well, the interest rate should be, the Fed should decide what this is. No, the interest rate should be a moving price, just like the price of anything else. It's the price of borrowing money. And if it goes up because there's less money available to borrow, or there's a greater demand for the money. But the interest rate should be left alone to fluctuate, to respond to the market. When you don't allow that, when you don't allow a price to respond to the fundamentals that are going on in the market, whether that price is an interest rate or the price of food or the price of cars or anything else, you create shortages and surpluses in the market. And like you do now, you either get into a period where there's not enough liquidity, or you get into a period where there's too much liquidity, and it's all because you're trying to manage something that shouldn't be managed.
So which item would be managed there? Because in the beginning of your response, they're not actually toggling interest, they're increasing or decreasing the money supply. So that's the mechanism to moderate or increase or decrease interest rates. So would you say that get them out of the business of that increasing or decreasing the money supply, or is there a cause prior to that you would target?
Yeah, I'll give you two answers: my sane answer and my crazy answer.
Okay.
And my sane answer is the Fed should do what Milton Friedman had suggested back in the 1970s, which is
computer.
Yeah, follow a rule.
Yeah.
Right. If the economy grows 2%, grow the money supply 2%. If the economy shrinks 1%, shrink the money supply 1%. But adjust the money supply to follow the economy. Follow a rule. That's my sane answer. My crazy answer is the government shouldn't be in the business of currency any more than it's in the business of setting interest rates. The currency should be private. And this is something where people's minds get blown, because we all kind of naturally assume that you need the government to provide a monetary system. No, you don't. We had private monetary systems in this country right through the 1800s, and they worked perfectly fine. Other countries have had in the past and still have today private monetary systems. They work perfectly fine. A government-sponsored monetary system is, on the one hand, you have what you might believe is the security of, well, this money is backed by the government. Okay, but on the other hand, you've asked this entity that doesn't have the expertise, nor does it have the skin in the game, to manage this vital resource. So we don't, going back to things like cars and food, we don't suggest anywhere that the government should control the production of food or the production of cars. We understand that's a crazy thing, but we ask it to control the production of money. That should be private too.
Yeah, the reason I said computer there is I remember Milton Friedman being asked this question. I think it was on like the 70s or 80s in a Donahue show, and he was saying like, just get a computer that has I believe it was the Taylor rule is something similar, right? Where you have some mechanism that's following get rid of the Fed, have this one program that just has it going up 3% or 4%, whatever it is, that it's consistent.
Yeah.
So
yeah, and I think to get your head around that, you have to accept something that's fundamentally true, and that is money is simply a tool. It's a tool we use to facilitate the transference of goods and services amongst people. It's the goods and services that matter. The money itself doesn't matter, except that it facilitates the movement of these goods. And so it's very much like running an engine, right? The oil matters in that it keeps the engine lubricated. But if you don't have enough or you have too little, you've got a problem. But your problem isn't the oil. The problem is the engine. The engine has to keep doing its thing. The oil should be in service to that, not the other way around.
Yeah, no, that makes sense. It's a good analogy. Now, I want to be mindful of the time right now, but I do want to get your thoughts on some of the policies surrounding real estate in general. And one of them, just this idea of basically saying that, I think you alluded to before, that you can have in your contracts percentage increases maybe that are connected to inflation. We did those a lot in government contracts, in commercial real estate. We've kind of gotten away from tagging it to employment. We would have step up increases, but we're starting to see again, attaching it to some sort of inflator. Now, when you have government policies like in a lot of areas here, but New York, California, we're more akin probably to those states in terms of policies where we have a curb on what you're allowed to increase your annual rent, especially on the multi-residential side where, they'll say 1.8%, 1.2%. And it's the idea of it is to follow some sort of inflationary target. But by the time it catches up to wherever we're at now, or if it does, probably be, years from now. So you have a situation where you can raise rent 1.5% because of a government policy, but inflation is now at 6%. What's going on there in that type of environment, and why what breaks down from an economic point of view when you have these type of hard and fast government rules, and then you have the economy trying to deal with them?
What you have is another instance of what economists call the seen and the unseen. And politicians only ever respond to the seen. They ignore the unseen. And here, the seen part of it is that if the rent goes up too fast, you've got people, I'm renting an apartment there and I used to pay $500 a month, and now all of a sudden I've got to pay $700 a month. I've got to scramble to make that work, or maybe I can't make it work and I've got to move, something like that. And that's the seen part. And the politicians will respond to that, because the people who am renting this thing, I'm going to complain to the politician. I vote, I get out there, I talk to my neighbors. Politicians will be very sensitive to that. What they won't be sensitive to is the unseen. And the unseen is when the politician steps in and says, okay, we're going to fix this problem by prohibiting anyone from raising their rent by more than 1.5% a year. The unseen part is, an entrepreneur who is thinking about investing in building apartments, I now say, it's not worth it. My investment has now become more risky, because if my costs go up, I'm not able to pass those costs on to renters. I'm now stuck with a bad investment. And so I'm not going to invest in the apartments that I was going to invest in otherwise. And now you've got less housing. But that less housing comes further down the line. In the politician we're talking about, if he's lucky, the voters won't associate that lack of housing with him and his policies. They'll blame it on you and you evil profit-seeking, apartment owners. If the guy's less lucky, he'll simply retire and move on to some other job and let the next politician deal with this problem.
Yeah, the unseen, it's an interesting way to frame it, because what ends up happening, I've found with these type of policies, is that to solve inconsistencies or issues with the policy, there's just a patchwork of more policies. So for instance, with this situation of 1.5%, we had a regime, which I still think is the case, that I think they saw outcomes they didn't like. So what they said, okay, here's the new rule. Anything built after 2019, you guys can raise rent, but everybody before 2019 can't. Almost trying to tackle that idea of, we don't want developers to be not encouraged to build. So we're going to allow them to have buildings that, you can raise rent, but still kind of keep the character of the policy that they had. But then it starts becoming a patchwork, and all of a sudden you have so many different regulations that you don't really know what's going on in certain markets. And I guess in addition to that unseen part of it is, we go to conferences all over the States and Canada, and there are certain markets people will not invest in just because the unpredictability of the regulatory environment on the real estate end.
Yeah, absolutely. And of course, we have that problem here in California. California has tremendous amount of housing regulations. It so much so that if I were to move to California and not have any housing and just pick a house and walk into it and say, okay, this one's now mine, the actual rightful owners are going to have a hard time getting rid of me, because the laws are designed to protect me, even though I don't own the thing, right? And so because of that, you'll have much less investment in producing housing, and politicians will do, what you're describing. They'll blame the greedy apartment owners, the housing contractors, and then they'll look for new policies. What new policy can we put in place? And here's the thing we have to keep in mind. Every policy, every single one of them that a politician imposes, creates unintended consequences. Things that the politician didn't intend to happen, but happen because people react to this law. And any new law I put in to shut down that unintended consequence, that new law itself creates unintended consequences, and you end up with this cascade effect of law after law after law after law, each one attempting to fix a problem caused by the previous law, and the problem's never ultimately being fixed because the problem is the law itself. Remove them all, and you won't have nirvana, but you will have a much better situation than you had to begin with.
Fair enough. Okay, we are coming up to the end of time here. Why don't you end us off on a positive note, Antony? What do you find is encouraging right now about whether it's the U.S. market or generally right now in the place that we're in for the future? What's the glass half full for you?
Yeah, so that's a good question. And I take you back to my earlier statement that what matters is the goods and services, not the money. The money is simply a tool we use to transfer ownership of goods and services. It's the goods and services that matter. And although we have all this problem with the inflation and the deficit, and in our case, the Social Security going insolvent, look on the bright side. We have all of our workers, we have all of our intelligence, our educations, we have our technology, we have our capital, we have our infrastructure. All of that stuff remains, which means we have the ability to produce tomorrow everything that we produce today. All of these problems we're talking about are all problems in shuffling the dollars back and forth. It's changes of expectations. It's, I expected to receive a Social Security check when I retired, and now I'm not going to, and I've got to now shift gears and come up with something new. It's the change of expectations that's the problem. But the real economy, the stuff we have to produce, it's all there tomorrow, same as it is today.
Antony, for those that want to connect with you, we'll put links in the show notes. Where would you send them to, whether that's on YouTube or the podcast?
My podcast, Words and Numbers, you can find at wordsandnumbers.org and on all the podcast players. And my YouTube channel, I have hundreds of videos on economics and policy and statistics. You can find that on YouTube under Antony, Antony, Davies, Davies.
My guest today has been Antony Davies. Antony, thanks for being part of Working Capital.
My pleasure. Thank you.